Hello everyone and welcome to the YouTube channel AMC Lawsuit and Justice. My name is Ethan and today we're publishing video 15 part 2 in the Daniel Meyer Transmittal Affidavit series. In video 15 part 1 we covered the timeline from April 22nd, 2022 through May 6, 2022 and reviewed two key exhibits. We completed Exhibit 24, the email thread between Jon Merriman and Shannon Rockford at the NYSC, and Exhibit 34, Citigroup's APES Rights Offering Overview. In this video, we'll dive into Exhibit 19 and 20, which I truly believe are the two of the most important exhibits in the entire affidavit. Exhibit 19 is the Jon Merriman email, and Exhibit 20 is the Jeffrey Weinberg email. So let's get started, and for that we need to jump to paragraph 14. But before we begin, who's Jon Merriman? And who's Jeffrey Weinberg? Okay, so first answer, who's Jeffrey Weinberg? Jeffrey Weinberg was a senior managing director at D.F. King. So let's reach paragraph 14. On May 17, 2022 at 8:31 p.m., D.F. King's former senior managing director, Jeffrey Weinberg, drafted an email with the subject matter titled referenced AMC Preferred Issuance and addressed the email to Kevin Connor and Eddie Goldbloch. Kevin Connor was formerly AMC's general counsel, and Eddie Goldbloch is in-house attorney as well, while CCing outside attorneys at Weil, Gotshal and Manges, Mercedes Tate Harmon, Corey Shivers, and Michael Stein, and his colleague at D.F. King, Senior Vice President Crystal Scordato. So here's the email, and let's just go straight to the exhibit. So here's the Exhibit 20. Let's scroll down. It reads bottom up. And this is Exhibit 21, so let's start back up. And here's the email. So here's the sender, Jeffrey Weinberg. As you can see, at D.F. King, that's his email address or former email address. Obviously, he's no longer employed there. It was sent on Tuesday, May 17th, 2022 at 8:31 p.m. It's sent to Kevin Connor, once again, former lead counsel. General counsel at AMC. Then we got Eddie Goldbloch, and then we have CC'd Weil Gottschal's attorneys, 3 of them. And then we have Crystal Scordato, who is formerly Jeffrey Weinberg's colleague. Subject matter, and then the email is addressed to Kevin Connor. So as discussed, for the preferred structure to be successful, the votes cast must be at least 50% plus 1 for. Now they're addressing votes cast. Now let's just go back a little bit. If you remember in video 6, we went over the May 4th, 2021 vote and the July 29th, 2021 vote. We went over Broadridge's data as well as D.F. King's voting data. And if you recall, in those videos, we discussed that on May 4th, the amount of outstanding shares were a little over 450 million shares, and the July 29th had the outstanding shares were a little over 501 million shares. And in that vote, in order to pass the proposals, the yes vote had to be a majority of the shares outstanding. So in order for any proposals to pass on May 4th, 2021, the majority of the shares outstanding had to vote yes, and that would equate to 225 million, a little over 225 million. As you can see, you take 450 million, 156,186, divide that by 2 and add 1. Same thing on July 29th. It was a majority of shares outstanding. And you take the outstanding shares, divide that by 2 and add 1, comes out to this. 250,890,121. Now that's for a majority of shares outstanding. Now they discuss in this email, the cast must be at least 50% plus 1. So they're changing the dynamics. All right, so as discussed, for the preferred structure to be successful, the votes cast and has underlined cast must be at least 50% plus 1 for. This is effectively a majority of votes cast standard and a much lower threshold than our previous voting standard, a majority of shares outstanding, where we required 4 votes from 50% plus 1 of the entire shareholder base, not just those that actually vote. From there, the question becomes the likelihood that we would receive support from a majority of votes cast. due to one, the fact that institutional shareholders do not like to vote until just prior to the meeting, and two, that both previous votes were pulled at least a week prior to the meeting. Our analysis is focused on A, the vote up until the day that the proposal was withdrawn, and B, certain assumptions for how the routine vote, as discussed below, would have been applied, and C, how the shareholder base has changed since last year. So based upon last year's voting, incorporating the estimated routine vote that would have been applied, the votes cast would have been 56% for prior to the institution's voting, with approximately 31.5 million vote difference between for and against, based upon certain assumptions of what institutional shares would have been voted for after the proposal was withdrawn. Taking a conservative approach, an additional 10 million for votes would have been added, increasing the for percentage to 57.7% and the vote difference to 40.5 million shares. We start with an advantage in achieving a majority of votes for, as NYSE could consider this proposal a routine proposal. That means that brokers that still maintain their discretionary voting authority will apply that voting authority to vote their customers' uninstructed accounts. These vote in two different ways. Discretionary voting, where brokers will vote in an uninstructed share with the management's recommendations, approximately 64 million shares as of the latest available data, of which we would anticipate splitting 53 million for, 11 million against, based upon previous voting patterns. Proportionate voting, where brokers will vote in uninstructed shares in the same proportion that their instructed shares were voted. Example, brokers X has 10 million customer shares, 2 million vote, 1 million of the 2 million that vote for. The remaining 8 million uninstructed votes are voted 50% for and against. 103.5 million shares as of the latest available data, of which we would anticipate splitting 27.4 million for, 76.1 million against, based upon previous voting patterns. Since the July 2021 vote, the shareholder base has changed as follows. Institutional custodial holdings have increased approximately 27.4 million shares. These tend to vote in favor of the proposal and participate as well. Net positive. Discretionary custodial holdings have decreased by 14.2 million shares. We will no longer automatically receive those positive votes at an 80% plus rate. Net negative. Proportionate custodial holdings at NFS Fidelity have increased approximately 24 million shares. These new shares will be voted proportionally to how the rest of NFS instructed share votes. Last year, these group of shares voted 29% for, net negative. Friendlier proportionate custodial holdings, example Goldman Sachs, MLPFS, etc., decreased by 12.5 million shares. Those custodian votes overwhelmingly in favor of the proposal last year, net negative. Based upon certain assumptions, including the likely number of shares actually votable by the index funds due to stock loan, with the same retail voting for rate of 28.6% and retail participation of 27 compared to 25.11 at the same time that July proposal was withdrawn, before applying any additional institutional votes outside of the index, Goyden Northern Trust, there would be voting spread in favor of the proposal of approximately 5 million shares, with the votes cast split at 50.11 for and 48.89 against. This provides a 44% quorum as compared to a 53% quorum at the July meeting, implying another 47 million shares unaccounted for. However, this 47 million share difference may be largely negated by the combined approximately 36.5 million shares that will not automatically be voted via decreases at discretionary and proportionate voting custodians. As can be seen in the movement referenced above, especially at NFS, this analysis is based upon a moving target due to the volume and volatility of the shareholder base. With certain assumptions, I believe that the unaccounted for shares referenced above would more likely than not be favorable shares through hedge funds and institutions, and when combined with certain campaign strategies that would be altered to account for the lower voting threshold, this campaign would ultimately be successful. At the same time, it is worth noting that the original May meeting, using a combined average of the top retail custodians, TD, NFS, Robinhood, Schwab, and Apex, as a proxy for the retail vote, retail voted for at 33.5%. At the July meeting, this same group voted for at 28.06. Based on the high-level analysis mentioned, if the retail for votes moves to 26.5% or below, the initial 5 million share advantage disappears. If helpful, attaching the latest ownership report based on the 13F data that came due this week. Let me know any questions. Happy to discuss. Thanks, Jeff. Okay. Now, at any point, do you see in the email where AMC and DF King are discussing where to sell shares, how to raise money? All they're looking is how to convert. They're looking how will a vote happen, whether they authorize more shares or they convert APE into AMC. All right. From the perspective of DF King and Company, Inc., and AMC, as outlined in the May 17, 2021 Jeffrey Weinberg email, for the preferred structure to be successful would involve the conversion of APE back into AMC even before APE was distributed to stockholders. Notably absent from the email is any mention of a strategy to raise capital effectively or to address debt repayment. Now, on May 19th, 2022, it's the same email thread. At 6:04 p.m., Kevin Conner drafted an email with the subject titled, same subject, AMC Preferred Issuance, and CC'd Adam Aaron, Eddie Goldbach, and emailed Jon Merriman and Sean Goodman stating. Let's go back to that email thread. We'll scroll back up. And here it is. Oops. Here it is. Sorry. So here's Thursday, May 19th, 6:04 p.m. to Sean Goodman and Jon Merriman. If you guys don't remember, Sean Goodman is the CFO at AMC. Jon Merriman is Investor Relations. Adam Aaron is obviously CEO, and Eddie Goldbach was or is AMC's in-house attorney. So he says, Sean and Jon copying Adam. Further to my note to you, on May 9th and per the below, we continue to explore with Weil Gotshal and DF King a unique dividend structure that might allow us to authorize more common stock. Once again, their intent is always to get more common stock, and then there's privilege redacted. Since I sent my prior note, we have checked with DE, which is Delaware Counsel, and this is redacted or privileged. We also checked with NYSE, and to my surprise, they have no objection. The tricky part now is determining whether if we implement something similar to affect share authorization, meaning if they do the same vote from May 4th and July 29th of 2021, would the vote carry? Per the below, Jeff at DF King has indicated he thinks the campaign would pass. I'm going to set up a call for Sean, Jon, Eddie, and I to speak with Jeff to hear Jeff's thoughts. We will challenge his assumptions a bit and get back to Adam as appropriate. Per Adam's note, not spending a lot of legal on this, and Jeffrey is free. Sensitive to Adam's concerns that stockholders' base might react negatively and that it might collide with our CSE offering, which is Citi's structure on the preferred, which is a rights offering. Balancing that sentiment against the prospect of authorizing and selling some shares at $10 per share late summer. Thanks, and call or write with questions or comments. Kevin. Once again, that's from Kevin Conner. All right. Now, Kevin Conner's May 19, 2022 email proves that the purpose of the unique dividend structure was aimed at facilitating the issuance of more common stock rather than focusing on debt repayment or restructuring. Now, on May 25th, now we get back to Brian and Mia with Adam Aaron. On May 25th, 2022, Brian messaged Adam Aaron, journalists are reaching out to me now. Then on May 25th and 26th, 2022, B. Riley Financial, Inc. hosted their 22nd annual institutional investor conference in Beverly Hills, California, and both Jon Merriman, once again, investor relations, and Sean Conner attended the event. Here is proof that there was an event. It says B. Riley Securities to host 22nd annual investor conference on May 22nd, May 25th, through the 26th, 2022 in Beverly Hills. Now, if you guys don't know, Riley Financial was our investment banker as well and underwriter. So what happens at this meeting? We don't know. Obviously, we weren't there. But subsequent to the conference, an email pops up. And mind you, it's May 25th and 26th is when the conference is. The following day, on May 27th at 1:40 p.m., Jon Merriman drafted an email with the subject titled Super Voting Preferred and CC'd his colleagues Patrice McNall, Lane Rizzolo, and his attorney at Duane Morris, Dean Colucci, and James Seary, and emailed Jon Merriweather and Sean Goodman stating. So let's go straight to the source. This is Exhibit 19. So here's Exhibit 19. For those who don't believe me, let's look at the URL. It's Transmittal Affidavit Daniel Myers in support of plaintiff's brief. And it's coming from BLBG's server that I downloaded. So let's go back. All right, so let's go. It reads from bottom up. All right, so here's the email. So it's from Jon Merriman. Once again, he's our what's it called? He's employed by Riley Financial, and he's the chief business officer at Riley Financial. So the email sent Friday, May 27th, 2022 at 1:40 p.m. Mind you, the conference was the 25th and 26th of May. And he sends the email to Sean Goodman, CFO, Jon Merriweather, Investor Relations. He CCs his colleagues. His attorneys. And his colleague, actually Lane Rizzolo is his colleague, as well as Patrice McNally. And then the subject is Super Voting Preferred. So he writes, Sean and John, great to see you guys this week. Thank you so much for coming to our event. Sean, I hope you didn't have equal drama on the way home. What a story. Suggest we get on a call with the lawyers next week and talk on this structure. Then you and your team could get with the NYC to see if this could work for AMC. In the meantime, Lane, which is this lady, Lane Rizzolo, could you please send NASDAQ precedents copied our counsel at DM, which is Duane Morris, who has helped us here. Suggest Tuesday at 10 Eastern time to start. Great weekend, everyone. Jon Merriman, Chief Business Officer. Let's go over this email. So you have the attorneys, Dean Colucci and Siri James at DM, which is Duane Morris. We have Patrice McNally and Lane Rizzolo as colleagues. So basically, John is telling Lane, send the follow-up email with prospectus, which will be prospectus for the NASDAQ precedents. What does that mean? He's referencing the subject, super voting. He's asking his colleague Lane to send, what will happen will be 3 prospectuses for 3 stocks on NASDAQ, OPGN, AVGR, and AGRX. And we'll get to that in a second. Now, mind you, AMC trades on the NYSE. So he's saying, listen, it was great seeing you guys. Let's talk with your attorneys to see what we could do. We set precedents on NASDAQ. Maybe you could apply what we did on NASDAQ and the NYSE with AMC. And have a great weekend. So what happens next? So then approximately 4 hours later at 5:58 p.m., Jon Merriman drafted another email with the same subject title, Super Voting Preferred, and CC'd his colleague, once again, Patrice McNall and Lane Rizzolo, and his attorneys at Duane Morris, Dean Colucci, and James Seary, and emailed Jon Merriweather and Sean Goodman stating, weekend reading, talk soon, Jon Merriman. So let's go to the source, scroll up, and here's the email. 4 hours and 18 minutes later. Sorry, hold on. Yeah. So 4 hours later, here's the same subject. It's coming from Jon Merriman. Then sending to Sean and John. Same people CC'd, his colleagues, and then the attorneys at Duane Morris. And here's the attachments. And that's where we're going to focus on. We got OPGN, which is Obgenic. And you can see the final prospectus. And you could see an underscore. Then it gives you the date. So remember, for OPGN, it's 2021 10/15. So I extracted that data and put it here. 10/15/2021 OPGN. That's the ticker symbol. I'm going to do the same thing for AVGR. I'll put the prospectus dates, and AGRX, same thing. So you'll see I'm extracting this data. So Then is AVGR, which is AVGR. You'll see 2022, January 13th, 2022. I extracted that data and put it here. So you see January 13th, 2022. And the next one is AGRX, which is right here, Agile Therapeutics. You'll see 2022, March 14th. So let's see. I've done that right. See that? March 14th, 2022. That's when the prospectus is filed. So he goes, weekend reading. Talk soon, Jon Merriman. All right, so that's the email. So now let's go to the prospectus. Let's see how it's structured. Let's see the notes that I put together. And then let's see how it applied on the chart subsequent to them moving forward with the super voting. So let's go. All right, so this is in reference to the Jon Merriman email. We have ticker symbol OPGN, as you can see once again. OPGen Inc. Which is OPGN. Then you have AVGR and AGRX. Then you have the prospectus, once again, October 15th, 2021 for OPGN, January 13th, 2022 for AVGR, and then March 14th, 2022 for AGRX. So let's go first with OPGN. Let's go to the top. This is OPGN. Now it trades on OTC. And let's bring it down to, what day was it? Oops. October 15th, 2021. October 15th, 2021. And here it is. This is it. I already hit the tab. And right next to it, you will see this is the prospectus. All right. So OPGN, this is the prospectus that he sent. And this is the information we gather in OPGN. OPGN did not do a reverse split with the prospectus. What we do know that on October 13th, 2021, the reason it didn't do a reverse split, the closing price of the common stock was $2.05. Now, mind you, if the share price ever breaks $1 on the downside, then the likelihood of doing a reverse split is enacted. And because OPGN was trading at $2.05, there was no reverse split. There were splits after in May of 2024, which was 1 for 10 reverse, and January 2023, 1 for 20. But during this prospectus, what OPGN was going to use now was to use a preferred, give it supermajority. And let's go over it for a second. Sorry, what page do you have to look at? S6 will give us the notes. So scroll down to S6. S6. All right. So the issue with OPGN didn't have to do a reverse split. So they didn't take a complete play-by-play book on how OPGN played out. What they did do is that they noticed that OPGN, let's go over here, risk related. What OPGN had an issue was they didn't have sufficient number of shares of authorized but unissued shares of common stock to offer such shares in this offering. So they needed to move forward with preferred. We're making an offer to sell shares of our preferred stock and the accompanying common warrants because we do not currently have sufficient authorized but unissued shares of common stock to issue in this offering. Now, what else they had is that the preferred stock has supermajority voting rights, in that the holders of preferred stock will be able to vote the shares of preferred stock with the common stock as a single class at the special meeting. Each vote of preferred stock will entitle the holder to cast 30,000 votes per preferred stock share at the special meeting. We needed to offer this preferred stock with supermajority voting rights because to date, we have not been able to obtain the necessary vote of stockholders to approve the needed amendment to our charter, despite a lengthy annual meeting solicitation process, including 2 adjournments and expenses associated with the use of a proxy solicitor. The issuance of shares with supermajority voting rights could be viewed negatively by our common stockholders and make it more difficult for us to successfully amend our charter to increase the number of authorized shares of common stock. Supermajority voting rights are an option approved by NASDAQ in only limited circumstances, such as the company's current inability to increase its authorized common stock in order to pursue common stock financing. So that's the story of OPGN. Now let's look at what happened to OPGN. All right, so mind you, this happened in, oops, let's go back, 10/15, 2021. 10/15/2021, somewhere around here. All the stock did was go down. And mind you, there was reverse splits here. So there's what did I tell you? There was a 40. There was a 10 and a 20. So you can divide by, oh boy, 1-to-1. You can divide by 20 and divide by 10. Anyway, what you could see is all the stock has done is gone downhill. And mind you, here it is. So here's October 2021. It was October right here. They had the vote. It went straight down. Then there's a reverse split here. And down. Wow. Psh, down to $1 at one time. Now it's $4.76. Oh man. Here it's trading at 500. So imagine if you were shorting this. How much money did these people who knew that reverse split conversion or the preferred and moving forward with this little scheme, they could take it down? How much money could be made? All right, let's address now AVGR. Now AVGR, January 13th, 2022 was when the prospectus was filed. We'll address pages S3 and S6. This one actually did implement a reverse split. The playbook that it adopted was using the preferred supermajority and also implemented a reverse split and conversion. So this was straight out what APE and AMC emulated. So if you want to analyze, this one actually took the time. Why was AVGR necessary to do the reverse split? Because at the time it was trading at 48 cents as it breached the $1 and the requirement that NASDAQ requires. So let's go to AVGR. Here is AVGR on the Edgar through SEC. And then we can scroll down, view filings. And once again, oops. That one was January 13, 2022. So let's go to Edgar, January 13th, 2022. And here's the prospectus. So you could hit that and it opens this. This is the prospectus. So this is AVGR. Now it tells us on January 11th, I highlight it, it closed at 48 cents. So it was required to do a reverse split. So once again, they did a preferred supermajority voting, increase the authorization, and then reverse split as well. So directly same thing as AMC and APE. And then they also did a rights offering. They had, I think, HC Wainwright that issue shares to raise capital, I think, if I recall. And if you want to read the prospectus, once again, you can go to SEC and Edgar, and you can get it right here. This is the prospectus. You can hit it. So let's go to one more. And sorry, let's go to AVGR and show you what happens subsequent, how it traded. All right. All right, so let's go back to the notes. So what happened to AVGR with this prospectus and how they move forward? So we're talking about March 14th, 15th was the split. January 13th or the 11th, they cite the price. So let's go to January 13th. Oops. And here it is. So March 14th, 2022. All right, here's the reverse split. And mind you, then it did, oops, let's go one more time, sorry. it did a reverse split of 1 for 20. So look, all it did was go straight down from 4 down to $1.05. Now, mind you, we were getting emails from Jon Merriman on May 27th. So they already had enough data to see that their stock that they told the conversion and reverse split went from $4 at the time they're writing this email and telling you, hey, you should try it, do it. It's now trading at $1.05. So this scheme and this strategy that they implemented took the stock down from 4 down to 150 in less than a couple months. All right, so let's go to one more. AGRX. Now, this prospectus was filed on May 14th, 2022. We're going to address pages 11 and 12. And the reverse split was done April 27th, 2022, 1 for 40. And when this prospectus was filed and it referenced the date, the stock was trading at 26 cents. Since its announcement and filing with the SEC, it went down to 11 cents until April 26th. So look at how the impact. So let's go to AGRX. Now this was the same playbook for APE and AMC. Oops, where am I? All right, so here it is. This is the reverse split. All right. So mind you, the announce. Let's go back again. So let's go. The announce on March 11th. Sorry, they file it on March 14th. Let's go to March 14th, 2022. All right. This is it. And it was trading, do the reverse split. It was trading at 26 cents on March 11th. All right. Then, what's it called? We got April 27th, they move forward with the reverse split, 1 for 40. And it trades at 11 cents. Oops, hold on, let me try this again. Oh boy. April 26th. So here's the date it's resplit. It gaps down. And here's the day it closes. So mind you, from the day it announced to where it closes and moves forward, it loses over 50%. Then all it does, since the reverse split conversion, all that stuff, is go straight down. All the way down. See that? $3 all the way down to 40 something cents. Keeps going down, and then it does another reverse split right here down the road and continues to go down. Just completely destroys shareholder value. And they knew about it. So let's go back again now to the day. They moved forward with this. And what did Riley Financial know about? This is what happens. This is when they did the reverse split. They told about the prospectus. They helped. Their attorneys helped the draft for all these three companies. Now, mind you, we get an email from them, and they're advising us, AMC, on May 6th. The stock is trading at $135. They did the reverse split at $4, or sorry, at $4.48. It gaps down and goes straight down. So it goes. Imagine, for argument's sake, $4. And the day Mr. Merriman is drafting his emails, Jon Merriman, AGRX closes at 133. Look at the impact. Lost size. And then further down the road it goes. So imagine, we still haven't launched APE and AMC. We launched it a year later, and the stock, all it did was crash. And they still move forward with it. All right, so we went over the day was reverse split. So AVGR and AGRX both did a reverse split. They used supermajority voting. They used the preferred to raise money and then do the reverse split. OPGN did not have to do a reverse split because it was trading above the $1 requirement for the NASDAQ. It was trading at $2. So let's go back again, full circle. OPGN was trading at $2.05 when the prospectus was issued. AVGR was trading at 48 cents. And AGRX was trading at actually 26 cents. And when the reverse split was moving forward, it traded at 11 cents. Look how much damage it did. Anyway, next when we get to 2023, we'll come back full circle, reiterate what we just discussed today, and focus on APE and the impact. So please focus. When this email from Jon Merriman was drafted and sent was May 27th. They meet on May 25th, 26th. Look what happened to these three stocks. And he's advising AMC, yeah, try this out. And all these stocks, all they did was crash. Okay, so let's continue. Now, attached, let's just review. Now, let's get to paragraph 23. So, attached to Jon Merriman's 5:58 p.m. email were prospectuses for the three issuers that we just went over, listed on NASDAQ, that utilize super voting preferred shares to force through certificate amendments. The issuers were Agile Therapeutics, or ticker symbol AGRX, AVGR Inc., ticker symbol AVGR, and OPGN, ticker symbol OPGN, or OPGN, sorry, Inc. Now, the email thread from May 27, 2022, authored by Jon Merriman, stands out as one of the most incriminating pieces of evidence. In this exchange at 1:40 p.m. and later at 5:58 p.m., Jon Merriman informs John Meriwether and Sean Goodman that his firm, along with his attorneys, had already established precedents for similar situations with three stocks listed on NASDAQ, AGRX, AVGR, and OPGN. Since AMC is listed on the New York Stock Exchange, no precedent has been set on the NYSE. Jon Merriman proposed that John Meriwether and Sean Goodman, that we get on a call with the lawyers next week to talk on this structure. Then you and your team can go with the NYSE and see if this could work for AMC. The significant decline in the value of AGRX, AVGR, and OPGN, each exceeding a 90% drop from the release of the preferred shares until November 2023, is a critical indicator of the detrimental impact these strategies had on shareholders' value. Even more telling is the fact that by the time Jon Merriman sent his May 27, 2022 notice email to John Meriwether and Sean Goodman, these stocks had already plummeted by over 50% since the launch of their preferred shares and continued to spiral downward. The actions taken on these tickers, including the implementation of a convertible preferred stock and multiple reverse splits, ultimately destroyed shareholder value. Jon Merriman's email dated May 27, 2022 at 5:58 p.m. provides direct evidence that AMC and B. Riley Financial were not only engaged in discussions, but were also fully aware of the detrimental impact that proceeding with the AMC preferred equity units and reverse split scheme would have on stockholder value. The striking similarities in the massive loss of stockholder value between the stock ticker symbols OPGN, AGRX, AVGR, and AMC implicates the AMC board, along with D.F. King, B. Riley Financial, and Citigroup Global Markets, colluded to execute a controlled demolition scheme. This scheme, seemingly modeled after the outcomes experienced by OPGN, AVGR, and AGRX, has been deliberately designed to undermine the stock value of AMC, thereby harming its stockholders. Notwithstanding Adam Aron's rosy public statement about AMC financial outlook, by no later than mid-May 2022, AMC's executives were exploring giving APEs special voting powers that would be maneuvered so management could force amendments of its certificate. And that concludes today's video, video number 15, part 2. Stay tuned for video number 16.